Hey traders, Mike Zer here. In today's video, I'm going to continue with part 2 of the two-part series where I show you the rest of the 10 ways that the rich manipulate the stock market and game the system to make millions or even billions. Let's get started. What if I told you that there's a trading firm on Wall Street that has never lost any money in 5 years of trading? Now specifically, it had only one losing trade in over 1,238 trading days. Now you're probably thinking, Mike, you're lying. You're saying that someone has actually found the holy grail of trading? Well, one firm, Virtue Financial, did find it and engaged in a different type of trading called high frequency trading, or commonly referred to as HFT. Now, HFT is a way of trading that uses powerful computer algorithms to transact a large number of orders in fractions of a second. Now, how it works is that these HFT firms are both buyers and sellers of a stock. So what they do is they place an order to buy while simultaneously placing an order to sell. And essentially they make money through the price difference, or what we call the spread. Now, for those who are scalpers, it's essentially the same strategy, but at supersonic speed, and these machines are essentially trading thousands of stocks each day. Well, what these so-called HFT firms just figured out was how to make money with essentially no risk by being faster than everyone. Now, it's pretty smart of these guys, right? But as detailed in the book Flash Boys, A Wall Street Revolt, written by Michael Lewis, this type of trading is actually rigged for the benefit of insiders, and the reason why these HFT firms are so profitable is they front-run all orders placed by retail investors, meaning that they jump in front of your order to buy, forcing you to pay more and then selling you back the same stock but at a slightly higher price. Now it could be 1 or 2 cents more, but imagine doing that thousands of times a day with thousands of stocks. Now that's big money, and those profits are coming straight from your pockets. Do you ever read articles like this where Wall Street analysts start issuing positive reports on specific companies and tell the public that this stock is a buy with a so-and-so price target, and then you see the price of the stock go up? Well, maybe you're thinking to yourself, well, isn't this stock price manipulation? Well, you're not wrong. In fact, this was actually the most blatant in 1999 when I actually first started trading, when Merrill Lynch's star analyst, Henry Blodgett, gave glowing ratings to specific companies that also had banking relationships with the firm, while privately telling his colleagues that these were garbage stocks. Now, this clear conflict of interest was allowed to continue until 2002, when the New York Attorney General Eliot Spitzer fined Merrill Lynch $100 million and forced all Wall Street firms to separate the direct link between their research and banking divisions. Now, the not so surprising thing was Merrill Lynch didn't have to admit to any wrongdoing. Now, things have improved somewhat, where nowadays when you read a research report, you will find an analyst's conflict of interest, if there is any, that's identified in the disclaimer. It basically discloses the type of relationship that the research firm has with the company being analyzed, and how compensation is paid to the analyst or the research firm, should there be any compensation at all. Now, I'm not saying that you should read or don't read an analyst report, but you should make an investing or a trading decision based purely on what an analyst says. Now, what you should do is you should do your own due diligence and your own research on the specific companies. Before I talk about the next way that the rich take advantage of the little guys, please take a moment to like this video. I would really appreciate your support. Okay, let me share with you how the rich stay rich or even become richer even when you hear in the news that they declare bankruptcy. The best example is ex-US President Donald Trump, who reportedly filed for bankruptcy 6 times. Now let me be clear here, he didn't declare personal bankruptcy, but his companies did. You see, the individuals who own the companies remain at a discrete legal distance, but still retain their profits from the companies even after bankruptcy. Now, I'm not a legal expert by any means, so take what I say with a grain of salt and how I simplify the explanation of how this all works. So basically, the rich set up companies which separate their personal finances from their business. So if the business fails, the creditors can't go after the rich's personal assets. In addition, the rich don't personally invest in the business with their own money, but borrow money from the bank or other investors. Again, if the business fails, then it doesn't affect their personal net worth. So here's what they do. So what the rich do is leverage a type of business bankruptcy known as Chapter 11. This type of bankruptcy allows their businesses to continue operating during the legal proceedings. This way, the rich are able to shelter the company's assets, fend off the creditors, and restructure the debt over a considerable time, and hopefully come out of bankruptcy stronger. Now, if not, no big deal. The rich just move on to another business. However, the biggest losers are the shareholders, who usually lose the majority of their equity in the process, and this is exactly what happened to General Motors shareholders. In June 2009, General Motors filed for bankruptcy with $82 billion in assets and $173 billion in liabilities. At that time, it was the largest industrial bankruptcy in history, and shareholders lost everything. The company restructured itself with the US government's help and became a public company again in 2010. Now just take a look at General Motors stock today. You ask yourself, who made a lot of money in this stock? You see, the surprising thing is the network that these rich people are a part of will still keep them rich, even if they stumble a few times. Banks and investors will still lend and invest in them. In fact, there's no stigma attached to bankruptcy in the business world. However, personal bankruptcy is another story. You see, if the rich borrow from the bank, and let's just say they lose all the bank's money, their relationship isn't really tainted because the bank employee who lent the money isn't personally affected, and most likely the rich also have a personal banking relationship with the bank, and because the bank wants to appease the rich client, who actually might end up starting another business that actually may do well, they will continue to lend money to the rich. However, if you declare personal bankruptcy, your life is pretty much over. Forget about even getting a credit card in your own name. As mentioned in the Part 1 series, over 60% of large cap money managers can't even outperform the market index. Well, let me tell you another fact. In my past videos, I profiled a few very successful hedge fund managers who made a lot of money for themselves as well as their investors. However, have you wondered why they're called hedge fund managers and what they invest or trade? Well, let me quote a Wikipedia page of the definition of a hedge fund. A pooled investment fund that trades in relatively liquid assets and is able to make extensive use of more complex trading, portfolio construction, and risk management techniques in an attempt to improve performance, such as short selling, leverage, and derivatives. Now that sounds pretty sophisticated, right? Not so according to the SEC's aberrational performance inquiry into hedge funds. Now, the SEC had set up a commission initiative in 2009 to combat hedge fund fraud, which included cases where there was fraudulent valuation of portfolio holdings, there was misuse of fund assets, and also misrepresentation to investors about critical attributes such as performance, assets, liquidity, investment strategy, and potential conflicts of interest. For example, not too long ago in July 2021, an investment fund manager fraudulently obtained over $20 million from investors through misrepresentation about his trading strategy and fund performance. So basically, this fund manager told investors of how he was going to manage their money using a very stable income-generating strategy through options. But what he ended up trading was something far riskier, and on top of that, he actually used some of the funds for his own personal use. So you have to be careful. So even though hedge fund managers will tell you that the fund has a certain strategy, you don't really know what that strategy is until after the result has come out. I've touched upon a few ways in my previous video how to make money in penny stocks, how traders engage in manipulating the prices of publicly traded companies that they control. So what they do is they artificially pump up the price of a stock by getting unsuspecting investors to buy into it, only to sell it at big profits for themselves. Now, typically these work mainly for penny stocks and cryptocurrencies, which means that you have to be extremely careful in trading these type of assets. Now, I've listed a few trading schemes that you need to be aware of. The first trading scheme is called churning. Now, this is when traders place both buy and sell orders at the same price, and their intent is to churn up or increase the trading volume, creating the illusion that there is strong demand for the stock, and then make it look more attractive to other investors and thereby increase the stock price. Another type of trading scheme is called painting the tape. Now, this is when a group of traders create activity or rumors to drive up the price of a stock. Now, this could be in a chat room or in a Reddit message board and could be coordinated to boost up the stock price. The third type of scheme is called bear raiding. Now, this is when traders attempt to push down the price of a stock by heavily selling or short selling the stock. Now, they could also put out false rumors or negative news about a stock and hence cause panic in investors. And quite frankly, this often is very, very effective because when you read about fraud in the newspaper or in message boards, you basically sell first and then ask questions later. The next trading scheme is cornering the market. And this is when traders purchase enough of a particular stock or commodity or any other asset to essentially gain control of the supply and be able to set the price for it. Now, I hope you enjoyed the series of how the rich make money in the stock market. Now, the purpose of this series is not really to scare you about how you can get taken advantage of in the financial markets. And really my goal is to help you realize that being informed and educated about how the markets work is really the best way to protect yourself and help you reach your financial goals. I'll see you in the next video.